Okay, let's get right into it. We're going to break down a very specific and frankly a very clever financial tool. It's one designed to tackle one of the biggest challenges so many families face, the absolutely staggering cost of long-term care. We're going to explore how something called a Medicaid-compliant annuity can be a critical piece of the puzzle.
I mean, this is it, right? This is the question that can keep you up at night. You work your entire life to save, to build a nest egg for your family, and then you see the cost of nursing home care and realize it could all be wiped out in just a couple of years. So the real question is, how do you get the care you or a loved one needs without losing everything you've worked so hard for? So here's our game plan. First, we'll dig into the core problem with Medicaid's rules. Then we'll introduce the special tool designed to solve it, the Medicaid-compliant annuity. After that, we'll go over the 5 critical, must-follow rules. We'll see how it actually works in practice, figure out if it's the right fit for you, and finally, see how it stacks up against some of your other options.
All right, so before we can even talk about the solution, we have to really get our heads around the problem. And it all comes down to this fundamental conflict between your savings and how Medicaid looks at your money.
Okay, this slide right here is the key to understanding everything. Medicaid splits your money into 2 different buckets. In one bucket, you have countable assets. That's stuff you own. Think cash in the bank, stocks, CDs. Medicaid says you have to spend this stuff down. But in the other bucket, you have income. That's money you receive every month, like Social Security. This is treated totally differently. And that single difference, well, it changes everything.
And here's the real dilemma. That asset limit is really, really low. In most states, it's just a few $1,000s. So to qualify, families are often forced to spend their entire life savings paying for care until they have almost nothing left. This is that dreaded spend-down requirement. And it's what this entire strategy is designed to legally and ethically work around.
So what do you do? How do you bridge that impossible gap between having too much money and assets to qualify for help, but not nearly enough to actually pay for years of care on your own? Well, this brings us to a highly specialized tool called the Medicaid Compliance Annuity, or MCA for short.
And MCA does one very specific job, and it does it really well. It takes a chunk of your countable assets, that money that's making you ineligible, and it converts it into a permitted income stream. You're not getting rid of the money, you're just changing its category, moving it from the bucket that hurts you to the bucket that doesn't.
You know, the best way to visualize this is with an analogy. Think of your savings as a solid block of ice. It's a static, countable asset just sitting there. And MCA basically melts that ice into a steady, flowing stream of water. That stream is your permitted income. See, it's the same water, the same value, it's just in a different state that Medicaid views in a completely different way.
Now you might be thinking, wait a minute, isn't this just hiding money? Won't Medicaid's 5-year look-back rule penalize me for this? And that's a great question. The key is you aren't gifting the money away. You are purchasing a financial product for its fair market value. It's a transaction, not a transfer, and that's exactly why, when it's done right, it doesn't trigger a penalty.
Okay, for this strategy to have any chance of working, the annuity has to be structured perfectly. We're not talking about just any old annuity. It has to meet 5 incredibly strict, non-negotiable requirements. Think of it like a pass or fail test. There is absolutely no partial credit. And these rules are no joke. First, it has to be irrevocable. Once you do it, there's no going back. You can't change your mind and cash it out. Payments have to start right away. The payout term has to be shorter than your statistical life expectancy. And this one is huge. The state has to be named as a beneficiary to get paid back for its costs after you're gone. You get even one of these details wrong, and the entire strategy is worthless. So we've talked theory, now let's get practical. How does this actually play out in the real world? How do you go from having too many assets one day to being eligible for Medicaid benefits, sometimes the very next? It's actually a pretty straightforward 4-step process. First, you or your advisor calculates exactly how much money you have over that Medicaid asset limit. Step 2, you take that exact amount of excess money and you use it to purchase a compliant annuity. Instantly, Step 3, that lump sum asset vanishes and is transformed into a monthly income payment. And boom, Step 4, your countable assets are now below the threshold and you can become eligible for Medicaid benefits, often saving your family months or even years of paying out of pocket.
And this is where the strategy can be a real game changer, especially for married couples where one spouse needs care. The income from the annuity can go directly to the community spouse. That's the one who's still living at home. This helps protect their budget and their quality of life, making sure they have enough money to live on while their partner gets the care they need.
So, this all sounds pretty powerful, right? But, and this is a big but, an MCA is a highly specialized tool, and it is absolutely not for everyone. It's all about understanding the trade-offs and figuring out if it actually fits your family's specific situation.
So let's lay it out. The upside is pretty clear. You legally protect savings that would otherwise been completely spent down, you get eligible for help way faster, and you can secure a spouse's finances. But the downsides are just as real. You lose complete access to that lump sum of money, it's locked up, it's irrevocable. The state gets first dibs on any money left over, and like we said, there is zero margin for error in setting it up.
So when you boil it all down, who is this really built for? Well, it's mainly for families in a crisis situation, meaning someone needs care right now or very, very soon. It's for people who are over the asset limit but don't have other plans in place, like a good long-term care insurance policy.
And on the flip side, who should probably steer clear? Well, if you have enough assets to pay for care privately, or you already have a great LTC insurance policy, an MCA is probably irrelevant for you. And if you're planning way ahead, more than 5 years before care is needed, other tools like a specific type of trust are likely a much better fit because they give you a lot more flexibility.
All right, before we wrap this up, let's just zoom out a little bit. It's really important to see where the MCA fits in the bigger picture. It's just one tool in a much larger toolbox when it comes to planning for long-term care. Take a look at this quick comparison. That column in the middle, best 4, that tells the whole story. Long-term care insurance and special trusts are fantastic tools for proactive planning when you're healthy and have years to prepare. But the MCA, it's purpose-built for crisis planning, for those situations where you don't have 5 years to wait. It fills that gap for families who need help now.
So at the end of the day, the Medicaid-compliant annuity is an incredibly powerful strategy for a very specific problem. It can literally transform a financial dead end into a pathway to get necessary care. But it also leaves us with a much bigger question, doesn't it? While it's a brilliant solution for a crisis, does the fact that we even need it disprove how absolutely critical, proactive, long-term planning really is in the first place? Something to think about. Thanks for joining me.